Our entire investment thesis, in fact, is based around knowing that things do go wrong. And so, how do we protect our investment in the first place? So, we're not going to buy an asset that we think we can't actually mitigate enough risks. Otherwise, it's not worth it, right? Hello, and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer, and excited to have you back here for another episode. Say, I was, you get these like, you go onto Facebook and it says you got a memory, and so I had a memory from what did it say? I think it was like 8 years ago. I bought a property, and about 15 days after I closed, I think it was exactly 15 days after I closed, a guy fell asleep driving his car, and he smashed into my building, and he it was crazy. This guy literally missed two trees that were almost the width of his car apart. And so he missed these two trees somehow, goes right in between them, and smashes into my brick building. The tenant that was living in that unit at the time was, if I remember the story right, she was in bed, laying there. She got up to go use the restroom. And when she came back, or when she was using the restroom, the car smashed through her unit, through the brick, into her unit, and was sitting right above her bed. Now, it didn't smash down into her bed, but bricks and, all kinds of stuff smashed onto her bed. And so she would have gotten probably pretty severely hurt if she didn't go to the bathroom at that point in time. So, blessing that she didn't get hurt. Nobody got hurt. Actually, the driver walked away. I think maybe he had some minor bumps and bruises. He definitely had some eagle loss, but that was about it. We ended up having to vacate that building. Of course, insurance claim, worked through that, vacated that building for a couple months. The city actually condemned it. Just because obviously structural issues, the person hit the electrical meters. So that was out. We had no power in the entire building. I think it was 12 units, if I recall right. The entire complex was 120. So we had a bunch of 12 unit buildings there. But anyways, the point of the story, as I'm looking at that and thinking about that, I'm going, man, it's something you just can't prepare for. And there's so many things in real estate, business, life, quite frankly, everything that you just can't prepare for. And I love it when I look at these like pitch decks, and I see these pitch decks, and everything's all blue sky. Everybody's just, oh, this is what's going to go right with the building. Here's what we're going to do, and here's our business plan. And everything's so blue sky, but most people don't even spell out the things that could go wrong. And of course, we never know. Like, we can't predict what's going to go wrong, but we can predict that. I can guarantee you 100% of the time that when I buy an asset, when I buy a business, when something will go wrong, things will go wrong. It doesn't mean it's catastrophic. It doesn't mean that it's going to put me out of business. It doesn't mean it's going to lose me a ton of money, but things just will go wrong. And that's just how it is. But sometimes things do go very wrong. And now, is there ever a scenario where you can fully predict that so many things are going to go wrong and cushion you from every last scenario? No, there's always risk. That's why it's real estate. That's why it's business. There's always risk. That's why you should have an outsized return for the risk you're taking, right? If you are taking a lot of risk, you better have a lot of potential return, right? You better be doing a lot of things to try to mitigate those risks, but at the same time, you'd better have a lot of return expectations. But so what I see a lot is these pitch decks, and people don't think through. They don't think through the scenarios that could go wrong. Again, we can never predict what it is, but you got to think through it. So what we do, um, and we've spent, by the way, we spent a lot more time on this over our last handful of deals than we did on deals years ago. And we really spent time thinking about, what can go wrong on a property. First of all, prior to even purchasing it, we're looking at that building. We're going, okay, what are the things that go wrong? Our entire investment thesis, in fact, is based around knowing that things do go wrong. And so how do we protect our investment in the first place? So we're not going to buy an asset that we think we can't actually mitigate enough risks. Otherwise, it's not worth it, right? So that, for us, it's not worth it if we can't do certain things with that asset to mitigate those risks. We won't even move forward with it. But so when we're looking at our scenarios, we go, okay, what can go wrong? And so if you look at our slide decks, you're going to see that we have what's our break even occupancy? When does this building actually make money and not make money? Uh, What happens if rents don't go up? What happens if rents go down? What happens if vacancy increases significantly and rents also decrease, or concessions happen, or we have a lot of bad debt? What happens if cap rates expand in the market at different rates? We're not just going, okay, what if cap rates go up by 25 basis points, by 50 basis points? No, what happens if they go up by 200 basis points, 300 basis points? What happens? What does our investment look like? And we're trying to get to a point where we look at things and we go, wow, a lot would have to go wrong for us not to at least be able to break even on this asset. That's what we're looking for, is we want to go, that just, it feels unlikely. Now, could a ton of things happen and us lose money on that asset? Absolutely. A ton of things can happen. But as we look at things today, we're going, man, that's really unlikely scenario. Like, there just so much has to go wrong for us to truly lose money on this asset that we feel good about it going forward. And I just don't see that a lot. I don't see a lot of people that are doing. I know people do that, by the way. We're not the only ones, certainly. But if you're a passive investor, by the way, you need to make sure that the GP that you're investing with is looking through that. Are they actually thinking through the things that could go wrong in the business? And that's not to be a naysayer. It's not to be negative about things. It's to be prepared for things that will go wrong. And so what are some of the things that we do in order to mitigate those risks? I already talked about the things we think through. But one of the things, like, so for instance, a lot of our deals, when we look at a real estate deal, we go, okay, what are the risk factors? Well, the risk factors, of course, are that we can't get our rents. The risk factors are that we have high vacancy, we have bad debt, we have poor operations, we have an economy that goes through some tough times, right? And then we do mostly value add. So we're adding risk to the table when we do a value add. It's much easier if we're buying a core plus asset. Core plus meaning it's brand new build, it's full, it's a great neighborhood, all that kind of stuff. That's core plus. But when we buy a value add, we add risk because we've got to do something to it to fix it. And so we're got to do some renovations. And so we go, okay, how do we mitigate the risk of the renovations? First of all, we've got to make sure we have everything spelled out. We know exactly what we're doing to that asset. We've really thought through it, and we know the costs associated with that. We know both the hard costs, what it's going to take, and we know the soft costs, meaning, look, we've got other things like some vacancy that's going to happen because we're renovating. We've got some higher utility costs because we're renovating. We've got maybe more interest that we're paying to the lender because we're renovating, those types of things. So we want to make sure we've got all of our costs built in, and then have a very conservative, like, oh crap, what if things go wrong? budget, right? So we want to make sure we have these big contingencies to make sure that if things go wrong, when they go wrong, we're covered. And so if we have a $2 million renovation, I want to have two to $400,000 set aside, maybe more, by the way. And that's on top of my itemized budget that hopefully has some slush to it as well. I'm not going to be going, hey, I got a quote for um, you know, $50,000 to redo the roof. I'm not putting that in my number. I'm putting $50,000 plus an additional, 10 to 15% on top of that for my roof, depending on, of course, the condition. If we think there could have been some leaking, I'm probably going to do 15 to 20% more because I don't know what's underneath it, right? So really thoughtful about those types of things is going to help set you up for success. And then, of course, we've got just regular operational contingency, extra budget, right? We want to make sure we have extra money set aside for anything that goes wrong. Then the other thing we do to really help try to mitigate our risk and to think through, oh crap, what if things actually go wrong? Is, well, let's fix our debt. And so if our debt is fixed and it's the longest term that we can get that makes sense for the project, man, that really helps mitigate risk and can help us prepare for problems. So many people didn't learn the lesson in 2000, 4, 3, 2, 1, whatever, and then 2008 happened and their debt wasn't fixed. And what happened? They got foreclosed on, they lost their properties, and the same thing happened again just recently. And so those lessons are still continuing to not to be learned. I see groups out there that are buying properties with floating rate bridge debt and they didn't learn their lesson and they're going to get burned. It just is what it is. They've got a ton of risk. And if you're an investor and you're investing in those deals, just know and understand that they're adding a ton of risk to the deal and you're likely going to get burned as well eventually. It's a ticking time bomb, right? It works at points and it doesn't work at other points. And sometimes you're just going to get caught. So we want to do things like that to mitigate that risk and to make sure that we're protected. Again, so many things go wrong. We don't want to be paralyzed by the fact that things go wrong in real estate, in business, and in life. Like if I thought through all the scenarios in life, in business, and in real estate, I just would be paralyzed by it and I wouldn't move forward. But sorry, I shouldn't say if I thought through it. If I thought through it and didn't then come up with the right strategy to be able to move forward, if I just allowed it to paralyze me, look, that's just what's going to happen, right? And so I think you have to really think through those scenarios, but you also have to come up with solutions to those scenarios. How can we actually protect ourselves and not get ourselves into trouble? How can we actually protect ourselves and move forward with the investment, move forward with the business? Any good business owner knows that things go wrong. Well, some of my favorite investors, by the way, are business owners because they know and understand that the investment is going to have ups and downs during its life. It's not going to be perfect. It's not straight line. Even though we build a straight line or fairly straight line underwriting model, increasing rents 3% per year, expenses are going to increase 3% per year. We're going to get done with 8 units. We're going to remodel 8 units per month, and we're going to do this for X amount of months until we're finished. Like, no, that's not what happens. We do 8 one month, we do 16 the next month, and we do 3 the following month, and then we do 7 more the next month, and so on. But eventually, we get to hopefully to where we want to be. Same thing with rents. Like rents grow 2% one year and maybe 1% another year, and then maybe they grow for 4% in 3 years in a row, right? We just don't know. And obviously we all see expenses. We've been watching expenses play out. Inflation is supposed to go up 2%. Well, what's happened over the last couple of years, right? It's gone up way more than 2%, but likely eventually here, inflation won't go up by 3% that it's going up. Hopefully it goes up by 1% or 0% for a set period of time. And that kind of brings us back to normal. So be prepared. Understand, look, the car can crash through your building at any time, but if you have a plan in place, insurance in this case, and contractors, and you just a good, uh, I guess we just really had a good team in place on the ground that was able to really help take care of that, plan through it, think through it, process all the information. We ended up coming out just fine. We didn't lose money because of that car crash. We were just fine. So have the plan in place, put the people in place, and understand that the things are going to go wrong. If you do that, not that every investment's going to be perfect, not that you can't lose still, but you're mitigating your risk substantially to where in the end you're likely to come out on top, right? You're likely to come out with a win, at least a minor win. And that's to me, know, not all we're looking for, but that's to me like, hey, if we can have every investment be some sort of minor win, we're really stacking it up in the end. It's when we lose that it really bites, right? It really hurts. And so if we didn't plan for those scenarios, it really bites us in the butt and it hurts and it sets us back. It hurts our reputation. It hurts, any kind of progress that we made. So, all right. With that said, man, I hope you have a fantastic rest of the day and make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out. And we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.